welcome to the download. I'm your host, Dave Richardson, and it is Tuesdays, an extended. Well, we're not going to be too long in terms of time, but long time between Tuesdays because we were stewing it up in London, England last week, and did you enjoy your stay in London, Stu?
My time in the Stu K.
I got another one for you in a second, but yeah,
Yeah.
did you enjoy this 2K?
Oh, it's always great spending some time with our advisors. The phenomenal work that they do with their clients and everything. Yeah, it's great.
Yeah, yeah. And then I carried on to Azerbaijan and Georgia. I nearly got mugged I got mugged in Georgia, and then I was in Baku, where you'll be interested. I know you're going to like this. There's probably more second cups in Baku than there are in Toronto. I know you
Really?
like your second cup. Yeah, yeah,
Yeah.
and they're all done up with like Canadian. So you got the standard second cup logo, but then they've got this additional logo on the side that has a Canadian flag in it, and then inside the store they've got little stands with an Azerbaijani and Canadian flag on a little post in every one of the shop, and they're everywhere.
There you go. Drinking your Paradiso medium.
Oh, is that your is
That's the
that your
big
go-to?
second cup. That's the second cup coffee. That's the
Well, there we
yeah.
go. So the only thing is, I tried to get them to change the name of the city to Bakstu. They're sticking with Baku, so
Yeah.
so you can get your coffee, but they're not going to rename the city. So
Yeah.
all of that catch up aside, Stu. So you're in London last week, and again we had a group of some of the best financial planners and advisors from all across Canada. You're addressing them. And I thought your presentation, in light of the circumstances, which is now a week in the past, and we'll talk about how a week doesn't seem to be a week in terms of looking at policy coming out of the U.S. that's having an impact on the global economy and the economy here in Canada and the U.S. in particular. But I thought your message was really important around just big picture. Where do we sit right now? How do you think of it? So when you're trying to piece together everything for an investor who's sitting there today, trying to figure out what to do, what to make out of all of this, what are some of your key messages, and what were you saying to the advisors last week?
Yeah. So maybe it's always kind of worth thinking about where we've been, what's changing. So this period of, kind of, for lack of a better word, American exceptionalism, the combined investment thesis of artificial intelligence and the enthusiasm for, some pockets of the market on that front, coupled with, the excitement around the election, around deregulation and getting the economy going at even a more productive rate. Um, like anytime, the long term of the stock market is always the earnings growth that we get and the dividends we get, and then we get valuation change in the interim, and the valuation change is often caused by these kind of thematic excitement or lack of excitement or this type of thing. So coming into the year, both of those theses received a little bit of a blow. The first
Yeah,
was
yeah,
the first was around deep seek and the and artificial intelligence, and it's not that it throws off the longer term potential. It just it it causes a discussion around that potential, and anytime there's a discussion, you're going to get a slight valuation change, right? Like, a valuation is trying to factor in a wide range of outcomes, and if the range of outcomes change a little bit, the valuation's got to change a little bit at the same time. And we've gone through that. And then the uncertainty caused by tariffs on, tariffs off, what will it do to the economy? What will it do to confidence has not been, welcome. You can see it in small business surveys. You can see it in big business surveys. People, the possibility of delaying decisions, things like this. So, um, that creates a little bit of a headwind to the economic forecast that might be in place. And then the third thing was, we look at this thing called the City Surprise Index, which had already started to decline a little bit, where economic indicators or economic evidence was coming in lower than where economists were expecting. So, we started the year with bond yields at a bit more elevated levels. They've come kind of screaming downwards. Um, and the equity market has had to digest, these kind of, three types of events. And simultaneously, um, elsewhere in the world, you started to see some relative strength. So you started to see big moves out of Europe and other things related to the possibility of more fiscal policy, more fiscal spending around building the military in Europe and what type of a response might be to supporting the Ukraine. And the reason that that's important is um, because every other time that the U.S. had corrected in the last period of time, say the last couple of years, it was still the only game in town.
Yeah.
So
Yeah.
when it corrected, it found, money wanting to still buy into what we just talked about. This time around, what people want to buy into on the U.S. has been, there's some doubt cast around it, and then there's a new alternative that might be emerging. So you've seen, moves that in the past might have been a handful of percentage points have been bigger because this kind of global capital has started to roil around a little bit, and and unfortunately that might persist for a while,
Yeah.
because you know we've talked in the kind of good and getting better, better and not getting even more better. Where we are in the cycle is a at a period of time where some of that volatility might stick with us for a while. um as investors, we what we tend to do is we think about earnings growth over the long haul. Like, I think it's a Howard Marks analogy, but it's a great analogy around the conveyor belt. And the speed with which you walk is earnings growth. Sometimes you're on the conveyor belt and it's going in your favor and you get more than earnings growth,
Yeah.
and sometimes you're walking the other way and you get less than earnings growth. So when you get a period of time where people worry about a slowdown, it 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 creates some uncertainty around not the long-term earnings growth, but how much is going to arrive right now.
Yeah.
And when that happens, the valuation tends to contract a little bit at the same time. So we got in the S&P 500, we've had, call it a 10% correction, not quite as bad at those levels elsewhere. Maybe they didn't start at quite the same valuation. But when you get correction, you want to be thinking about, how would the correction end? How would I put more money to work? Because at the end of the day, if something's corrected, even if it just went back to the old highs, means there's return to be had, right? Um, we're always running scenario analysis to try and think through, if things are too good, could they get worse? When things start to get, worse, as we've seen in the last couple of weeks, for sure they can persist, but you want to be trying to turn that volatility into your friend as long-term investors.
Yeah. And Stu, we've been talking for many months now. So I think for anyone who's been listening to this podcast regularly, over the last year in particular, but over the 4 years that we've been doing it, Stu, it's been almost 4 years now. I don't know if you realize that, but it's this whole idea, as you started with American exceptionalism, and America has been the game. You're winning because the currency is winning. You're winning because the economy is winning. The individual stocks are winning. The sectors where you're getting the best performance in the stock market, or where there's the most enthusiasm around a sector, the best companies are in the United States. So the U.S. is your game. So then you move over time, and all of a sudden you're left with a section of the U.S. market that has a very high valuation, and the rest of the world, and including a big chunk of the companies in the U.S. market, have pretty reasonable valuations, even though their performance has been pretty good. And there's your treadmill, or
Yeah.
your moving sidewalk, right? Because if you're walking and you're in Europe or Canada investing, and you're walking along on the regular floor, and then the people who are on the moving sidewalk are invested in the U.S. and they're just moving ahead, even though you're walking at the same speed. So there's that connection. But the at some point you get to a place where you're so stretched in the US, and I know I'm repeating a lot of what we've been saying over the last year because we said it over and over again, right? And this is the thing about the timing on these. You never know exactly what the timing is going to come, but you've got that difference that's getting wider and wider and wider. At some point, it just can't get any further stretched apart. And what do you need? Well, you need some kind of a trigger, right? And so you as you said, deep seek. So that's the whole around AI, and that maybe AI is not going to need as much infrastructure or as much power or as much of anything that we thought. So it disrupts that. And the U.S. is shifting policy in a way, not only as the policy could very well be the right policy. We don't we would have issues with tariffs. I'm sure you talk to Eric or any economist, tariffs are no good, and that's kind of an across the board view. But the maybe even if the policy is good, right now the policy is being applied in a way that feels really inconsistent and really uncertain for market actors. So all of a sudden you get that shift, and like you said, there was nowhere else to play, and we're sitting over in England. I think we were in the same conference room together, listening to a presentation from the chief investment officer at Blue Bay, right at Blue Bay Asset Management in the UK, right at the moment where Germany makes the announcement that they're going to spend, uh, you know, hundreds of billions of dollars in terms of fiscal spending. They're going to break a rule that has been in place around their deficit and fiscal spending, government spending, that's been in place for decades. Uh, and all of a sudden, like you say, you go, wow. So the U.S. in terms of fiscal is cutting back. We're not getting a whole lot on monetary policy because the Fed seems kind of stuck right now. They're worried about the uncertainty of policy. And hey, here are the Europeans coming in. They're going to spend a lot of money in markets. And all of a sudden, wow, Europe kind of looks a little bit exciting. And it was already getting some momentum to begin with. So you're starting to see all the things we've been talking about start to play out. Never a guarantee, obviously, right? Because it could just be a brief. But as you said, it's interesting the way this has played out. And for people watching, listening, and watching the podcast, I think they're not shocked by what they're seeing, whereas somebody who's not listening to the podcast. And by the way, subscribe, listen, give us a 5-star review for all that knowledge that we've imparted to you. People who are listening are not surprised because this is not that unusual a shift in markets given the backdrop that we've been talking about.
Yeah, no, I think that's bang on. And then when you get into these environments like you do all the time, when stocks go down, you recheck and redouble your analysis. And when you have like the math that says this company is going to be fine over time, unfortunately that math doesn't stop the stock from going down on any given day. When we get into these situations, there's some emotion that picks up, and we've seen that in some of the sentiment surveys. There's some investors that might have used leverage, so they have to adjust their portfolio, and that may not entirely be their choice. But when we get into those situations and we look at the math of what we own and how that business could look 2, 3, 4 years from now, and kind of a normal valuation that we might apply to the earnings that would arrive then, and we start to see pretty good returns, and we see reasonable dividends that are being paid to us today. Like even we always joke about, or not joke, but we talk about dollar cost averaging.
Yeah.
Maybe we joke about the cape that I might have, but even when you're collecting dividends, that's another way of dollar cost averaging, right? So so if I'm putting money to work and my companies are spitting off a bunch of money to me, the amount of money that I'm putting to work on a regular basis, really starts to work in my favor in an environment like this.
Yeah, and I'm a little bit surprised that we got to dollar cost averaging as a discussion subject in this particular podcast. It's actually outright shocking to me. But yeah, dividend reinvestment is another way of that, taking that money and reinvesting. So you get a dividend paid out right now, you're buying stocks at, 5 to 10% below where you were, just a couple of weeks ago. So that's fantastic. But as you say, all joking aside, we've been talking about this dollar cost averaging approach under with acknowledging that these kind of things happen in the market with a surprising frequency, right? Like that nothing goes straight up. So to have the market pull back 10% or even 20% is, it happens pretty much, well, 10% every year, pretty much.
Yep.
20%, one every 5 years. And if you're dollar cost averaging and you stick with that discipline, then you're buying right now when the market's down 10%, and you're loving it because you're getting 10% off on that particular purchase. And if the market goes down further or stays down, you're buying at that lower average. And then at some point in the future, as you say, that company may be fantastic. The stock's down just because sentiment has changed, but at some point, sentiment will reappear, or those animal spirits will reappear. The company will be judged on its strength, and the stock will move up, and you've taken advantage of it. Sorry, I walked all over you, throwing the cape on and starting to talk about dollar cost averaging in the way that only you can.
Yeah. Well, no, it's and I can't even do it justice after the it was just because it's perfect. Like it's the way of turning the inevitable volatility in the stock market, and the up period of the stock market tends to come in consistent increments for a period of time. The downside always tends to come in more abrupt fashion that tests emotions a little bit more. Um, you you kind of think about as stocks rise, you're not running out every day saying I need to have a party. It's like over a long period of time, and you're like, wow, that's when things get maybe more excitable. On the downside, the emotional change seems to be quite immediate. um, and we've certainly seen that in the last couple of weeks. So having a plan that's not dependent on finding the exact low. We've talked about that on stocks, about how rare the instance would be to get that all correct. Just having a plan that says if this persists, I'm going to carry through. If in fact right now is the low, I'll have done something, and I'll have better returns as a result of it. It's just a good way to kind of turn the volatility of the market into your friend.
Yeah, for some reason, I've got the theme to the Mary Tyler Moore Show running through my head. Who can take a crappy day and suddenly make it all seem worthwhile? Well, it's you, Stu, and you should know it. With each glance and every little comment, you show it. There we go. That's we know the demographic on this podcast, Stu, so don't worry. People will know the Mary Tyler Moore Show. So I'm not. Some of the younger viewers internally may not, but the bulk of the audience will. And I mean, that's really what you're trying to do. You're trying to, when you're investing, and this again, we always try to highlight. So what is Stu doing versus, say, me, who's just an average investor out there? I've been around the business for a little bit, but say an average investor, and the average investor is like, oh wow, I'm panicking, I'm down 10%, I don't like this. Stu is sitting there going, how do I turn this, what's happening right now, into an opportunity to improve my long-term returns and to take advantage of it? And it's done with just clinical precision and no emotion. You can see that on his face right now. No emotion, just flatlining, right? It's never, oh no, the portfolio's down right now. It's okay. There's something happening in the market. I am going to do the analytics to make sure that I understand how I can take advantage of this for people who invest with me, right? That is like, you're doing that first. You're doing it whether the market's up, down, sideways. It's almost an obsession with someone who is a professional investor, and particularly someone like you.
Yeah, no, it's the farmer analogy is you're out in the fields every day. Some need
Yep.
water, some need a little tending to, but you're always looking for opportunity.
Yeah, and if you can do that, and then one of the ways, so you start to look at, say you got a dollar cost averaging plan. One of the things you could do with dollar cost averaging, and not suggesting that specifically now, but you can accelerate your dollar cost averaging when the market does correct, right?
Yeah, you can accelerate your dollar cost averaging. The other thing is if you're in a balanced fund, you get rebalance, like you get multiple layers of, kind of putting the odds in your favor, right? So bonds have rallied, stocks have sold off. You might have rebalancing right off the
Yep.
bat. That, helps you in that form over time. Then you could have dollar cost averaging. Then you've got dividends coming in. There's multiple ways that, that the portfolio can take advantage of downturns to better the long-term outcome.
Yeah, and then like you say, if you're doing that consistently over the long term, every time you go through each cycle and each correction, the power of all of those pieces that you have in place are expanded. They're compounded essentially because each time you go through it, there's more and more at stake and more ways that you're adding money in.
100%.
So Stu, the only other thing I just wanted to check in on is, and I know this isn't your specific area of expertise, although you can talk about pretty much anything investing. Anything going on in the bond market that concerns you? Because we've seen quite a bit of movement in some of the longer term bond rates and short term rates moving up in the short term. Some talk around inflation. Does anything there concern you at all, or is that the reaction in the bond market been a little more muted than what we've seen in some areas of the stock market?
Well, there's the kind of the longer dated bonds have come down.
Yeah,
Shorter dated bonds have come down a little bit, although not too much.
yeah,
So the total return of bonds has been kind of above the rate that you've been taking coupon in. The next area of the bond market that is credit. And so on my dashboard of things that I would look at, I would have investment grade credit spreads and I would have high yield credit spreads. And that is a very good way of saying is the bond market worried about the economy? So if credit spreads start to widen, it could be a little bit of a sign that the bond market is worried about the economy. There's puts and takes here because the absolute level is not bad. So if like say a 10-year bond rallies by 50 basis points and the high yield bond doesn't move, that means spreads have widened by 50 basis points. But your absolute return is the same as it was.
yeah,
So we have seen some minor movement in credit spreads, but we haven't seen the same volatility in credit spreads that we've seen in say the equity market volatility, or the type of volatility that might come with real concern. So we watch that pretty carefully. I think people would like bond yields. It would be great if they stay here. If they go down a lot, it probably means that the economy is slowing a little bit further. Um, and that's why even in a portfolio, we still have the bonds still provide that option.
yeah.
And this kind of an interesting stage right here, because as you're thinking about dollar cost averaging and maybe thinking about the equity market, the bond market buys you some insurance.
There
So
you go.
if you're going to keep getting equities at a lower price, it probably means that your bonds will be at a higher price.
Yeah, and so when we package it all together, and this is why I like this discussion, because it just is a back to basics. You need a moment like this in markets after the markets, particularly the US, just seems to be going up in a straight line. We know nothing goes up in a straight line, but it's a reaffirmation of the principles that will make you a successful investor. One of the last ones, because we've touched on some others already through this podcast, diversification, right? And as you said, if you're in a balanced fund, well, what's the bond portion of your balanced fund done? Well, it's actually provided the insurance against this change in equity values.
Yeah, like the bond market is not dissimilar to that conveyor belt as well, right? Like you collect the coupon, and if the economy weakens, you get more than the coupon. And if people are worried about the economy strengthening, then you might get a little bit less for a period of time. The nice thing about a bond is it also matures. So if you hold it right to maturity, you're getting the coupon. But yeah, so in the last couple of weeks, we've seen that longer dated bond come down in yield, which is added to the price performance, cushioning a balanced portfolio.
Yeah, and hey, we can close it all up after my 24 hours of travel yesterday. Coming from Azerbaijan through Warsaw, had a delay in Warsaw. Actually, got to go to downtown Warsaw, which, by the way, is beautiful. If you haven't been to downtown Warsaw, fabulous. Then another flight, like I think a 9.5 hour flight to Toronto. So 24 hours of travel. Normally, I go blowing past the people. I just walk on the regular carpet instead of taking when you come into Toronto Pearson and you take all these the moving sidewalks. Right? I just go blowing past people because they block you in that. I was so tired after all my steps, kind of like the stock market after all the heavy lifting is doing. I got on the moving sidewalk and just kind of stood there and let it carry me to customs. And the bond market is like you say, is doing that work for you right now, while the stock market is, is adjusting, and in not that unexpected way. So it all comes together in terms of staying calm through whatever period, making sure you've got the right strategies in place, dollar cost averaging, being not being emotional in any way, always looking for opportunities whenever there's volatility. And then that diversification is critical. And you want to keep some powder dry. And so that when you get a correction like this, you can sit and assess whether you want to put that money to work, or maybe wait for even more bad news to come and then deploy it later. But these are fairly simple strategies that we talk about in some form or another, seemingly every week on Tuesdays, and they're all kind of coming together right now. And again, I hope what we've accomplished for people who listen regularly is that no one is surprised by this. This is just, oh, yeah, I knew this was going to happen. So good, I've got this strategy in place that's taking advantage of it, or I can shift this way to take advantage of it. And that's what we're trying to accomplish. We're trying to educate. We're trying to help people, do better investing long term. And nobody does it better than you, Stu.
Well, thanks, Dave. And thanks to
But
everyone who's listening.
by the way, did you get that sweater in the Stu K?
No, no,
Because I haven't seen that sweater. It's lovely on you. Your eyes are just popping here on the screen for everyone watching on YouTube, where you can subscribe to watch us on YouTube too.
That's a great segue to YouTube, Dave.
Yeah, and a great segue to finish, Stu. We'll see you next week. Thank you, and everyone,
Thank you,
all
Dave.
the best investing, all the best. These are the times where you can really take advantage if you think, stay calm, make some good decisions, and we're going to be here to help you through it.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only, and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.